Hi. Hello? Okay, I think we are on for our Orbex Fibonacci Power Retracement webinar. First, I'd like to go ahead and do a confirmation of our audio. And second, I would definitely like to thank you, everybody, for attending. We have a growing number as I speak. Attendees are growing. And so we want to, first of all, make sure that everybody understands that this is going to be an interactive webinar. So I'd appreciate it if you could answer the questions. Just type in your little chat box down in the gadget, the webinar gadget. Don't be shy. Your comments are not going to be shared with everybody, but I will see it and I will respond to your questions. And sometimes we do get a little bit too many response or questions, and if I don't get the chance to respond to you right now at the live webinar, just don't hesitate to email me later. I will provide you with my email, or you can email Orbex directly to get your questions, or even better, we can answer your questions in a whole new webinar in the coming weeks. So we're doing the auto confirmation. So please type in a yes to see if you can hear me. Okay? Type in a Y. That's even easier. Okay? Mohammed, you can hear me? Great. We're having Zayden. He can hear me. That's great as well. Just type in a Y if you can hear me so we can go ahead and start with our Orbex webinar today. We'll wait probably a little bit in about 2 minutes just to make sure that everybody is in. So today's webinar is going to be very interesting because I'm going to talk about one of my favorite patterns, one of my favorite technical analysis tools, which is called Fibonacci, and I'm sure that you already know because of the name of the webinar. So not only we are going to talk about what Fibonacci is or who he is, we're going to find that out, but also how we're going to use his features in our technical analysis. Even if you are familiar with Fibonacci, if you already use the retracements in your trading, you can I think you're going to take something away from today's webinar as well, because sometimes people can just forget how powerful this tool can be. So today's agenda, first we're going to introduce Orbex, you already know about. We're going to introduce Investiva. Then we're going to focus on the market intro. And just for the beginners that are joining us today, we're going to define some of the common terms that are used in Forex trading or any kind of technical trading. Most of the terms are usually actually used in other charted markets as well. You name it, stocks, commodities, ETFs. And so we're going to have a review on all of those terms, and then we will dive into Fibonacci and stop and limits. And after we have comprehend all the features, we will actually go in to the live markets and see how Fibonacci is working out some of the currency pairs right now as we speak. So that should be very exciting. Okay, so next, before we start, I want all of you to get prepared. Please grab a pen and a paper to take notes, because you know why? Because sometimes writing is the best way to memorizing. And I want to make sure that everybody is on the same page. So, okay, we're getting more Y's over here. And the number is growing. Okay, so let's get an introduction. Before I introduce myself, I want to know what type of people we have today. Can you type in your chat box what kind of industry you're in? Are you a teacher? Are you a lawyer? So we can have a more customized webinar. Okay, let's look at the comments. Muhammad is a retired. Okay, that's great. Jack is a student. That's great. Okay. So just typing what you do, what type of industry you're in, and maybe you can even share with me why is it that you want to learn more about Forex trading. Yeah, so the reason why we're doing this is because I want you to understand that today's presentation is not about me, it's about you. I want you to feel comfortable and be interactive throughout the webinar. I'm repeating myself because I'm seeing a growing number of our attendees. So, okay, that's great. Thank you for your responses. It makes me feel that we are actually in a classroom, which is sometimes hard to feel when you're doing a live webinar. Okay, so let's go to the introductions. First, let's introduce an up-and-coming Orbex Traders library that you can see a snapshot of what it's going to look like. It's going to be a little bit different, I think, in a week, but they have prepared, well, in the collaboration with myself, a number of items that is going to help you make a better and more responsible trading, have a better investing experience with Orbex. So it's going to have a lot of videos, education videos, market updates, ebooks, infographics, trading tips and analysis all in one place. And furthermore, because we all value your comments, there is going to be a blog that you can share your trading experience, your trading story, and if you think that something is missing from the library, you can go ahead and share your thoughts on the blog so that everybody can benefit from it. So it's going to be awesome. At Orbex, everybody is very excited about it. I'm very excited about it as well because I've contributed to the education package and the market updates. So it's going to be awesome. Don't forget to check it out. It's going to be live in a week from what I'm understanding. And here is a little bit about myself. My name is Kiana Danial. I am Persian from Iran. It's from the names that I can see in our audience today. I think we probably have some people from the region, even if not directly from Iran, it should be somewhere in our neighborhood. I don't live in Iran anymore, but then I decided to go to Japan. And let me tell you the story. The reason why I want to tell you the story is because I want to hear your story at the same time as well. So don't hesitate to just type in your chat box and see if you're going to relate to my story, how I started Forex trading and why. So I went to Japan for college, and I was an electrical engineering student over there and had no idea about finance or trading whatsoever, and actually, to be honest with you, no interest either. And what happened was that I noticed a lot of people in Japan, especially women, they trade Forex to make additional money. And in the 2008 market crash, when the dollar was crashing, one of my Japanese friends, actually not a friend, my Japanese mother, my host family, she told me how I can take advantage of this phenomenon and make money as the dollar is going down. So while everybody around the world was losing money in the stock market, I doubled a $10,000 investment in less than a month. So that was very interesting for me because even though I was not educated at the time, it's about 6 years ago. So you might say, oh, so I'm not, why am I listening to someone who's just been in this market for 6 years? But I'm going to tell you why. That's because Forex trading is not as hard as it sounds. And when you get your feet wet, you can be very successful in it as long as you're educated and as long as you make responsible decisions. So this is what exactly happened, and as you might know, the Japanese people's stereotype is being very risk averse. And that is why they analyze their trades a lot before they make a final trading decision. And that is the reason why Forex trading is huge in Japan. Do we have any attendees from Japan today? Type in a yes. Okay. Apparently we have no Japanese here today. So that's fine. I'm not really Japanese, but I do consider myself as a Japanese because I lived there for such a long time, around 7 years. So anyways, I started trading in Japan, and I became so interested that I decided to give up my engineering career and become a full-time Forex trader and educator. The reason why I added the educator part to it is because after I came to the U.S., I'm now located in New York, even though right now at this moment I'm not in New York, I'm in Florida. I'm overlooking the beach, which is pretty awesome, but we are working even though it's the perfect beach day. So in America, people are not very familiar with Forex trading, and they are not familiar with the importance of education. And that is the movement that I started. My first book was published by McGraw-Hill about Forex education. I'm the founder of InvestDiva.com, and you have probably seen me on the media, CNN, MSNBC, The Street. In my articles are being republished on so many different medium online. So that's a little bit about me. Do we have any attendees today who are just starting Forex trading and have never traded before? Type in a yes. Type in a yes for a. Type in a Y for a yes. All right, Kate has never traded before. That's great. Don't be scared. We are going to dive in with the easiest part of Forex trading. What is Forex? So I'm assuming you've heard of Forex before. It's a foreign exchange market, the largest market in the world. It is 53 times larger than any stock exchange. New York Stock Exchange alone is 53 times smaller than the Forex market. There is around $4 trillion worth of transaction on a daily basis in the Forex market. So this is a very, very deep market. It is very hard to crash. I don't believe it's going to ever crash unless we have a major World War III atomic. It's not going to crash unless we have one of the currencies vanish suddenly, which the odds is very, very low. So that is a good thing about the Forex market as opposed to the stock market, because when you're trading the stock market, you have to follow thousands and thousands of companies and the stocks and their employees and what's going on. But with the Forex market, there is only 7 major currency pairs that you can see in this picture over here. The 7 major currencies are the ones from Europe, the US dollar, of course, Japanese yen, British pound, Swiss franc, Australian dollar, and Canadian dollar, and New Zealand dollar. These are all the majors. Some people may ask, why is New Zealand a major currency, even though New Zealand is not that much in the map of the global economy? Well, that's because it is very close to Australia, and it has a threshold in the international financial industry. And another advantage of foreign exchange market is that it never stops throughout the week. Unlike the stock market that stops at 4 p.m. in each country, the Forex market, because of its international and global nature, it doesn't stop. So you can trade at night when you're having a sleepless night. You can trade it early in the morning. You can trade while you're working. And you can trade throughout the sessions, London session, Japanese, Asian session, and the U.S. session. We will get into that probably in the coming webinars, not today, how the different sessions affect the intraday market movements. But today we're going to focus more on the Fibonacci. So just briefly, one other advantage in the Forex market is that it does move in cycles. Again, stock market, in an overall long-term view, if you have your shares in a good stock, you can expect it to just go up, right? People who trade stock market on an intraday basis, it is a little bit different, but in a long-term view, the stock market usually goes up. But the Forex market, because it never crashes, it moves in cycles. What goes up must come down, and again, what goes up must come down. So all you need to do is to identify these downs and the ups that we are going to get into a little bit more. But before we get into that, I want to talk a little bit about high leverage in the Forex market, which is a blessing and a non-blessing at the same time. It's a double-edged sword. You have to be very careful with it. The high leverage that is available in the Forex market, that is actually going down in some countries, but I believe that Orbex in most countries gives you a 500 times leverage, which if you're in a good trade is phenomenal. You can multiply your profits by 500 times, but if you're in a bad trade, that is at the same time going to basically burn all your investment. You are never going to be in debt when using leverage, but it can burn out your investment. So you have to be very careful with leverage, and if you are going to add a high leverage to your trade, you must be very, very sure, and you must have analyzed the markets from all different points of view. If you had joined us in our previous webinars, we did talk about how to choose a currency pair, we did talk about the fundamentals, we did briefly talk about different chart pattern analysis. So before making a trade, you must check in with the fundamentals, with market sentiment, with indicators, with chart patterns, and of course Fibonacci that we are going to talk about in a little bit. So again, for our beginners, these are the simple steps to get you into our main topic today, how to make money in Forex. Exactly the same way you make money in any other market. If you have a shop, if you trade stocks, if you trade equities, if you trade oil, you buy low and you sell high. So you make money on the way up. Mostly with the stocks, that is the only way you make money, only on the way up. But the good thing about the Forex market is that you can also make money on the way down. The reason why is that the Forex market, the currency pairs come in pairs. So for example, let's say euro goes up and dollar goes down, right? You can make money when the euro is going up, and you can make money when dollar is going down, and you can have it. You can have these two trades simultaneously, which is one of the powerful features of the Forex market. So we did talk about the market cycles as well, and I want to talk briefly about the resistance and support levels that you see in this picture. So resistance, the reason why it's called resistance, you see this market is going up in an overall uptrend, but in a zigzag pattern. And every time this market is trying to go up, it is hit by this barrier, this imaginary line that I am going to talk about it, how we identify the resistance, these lines, this line levels. But it's kind of a boundary. It hits this top, and then it's forced to go down again. It's all market psychology. And then it hits another line, and it's forced to move up again. So whenever the market hits an imaginary line, a border that prevents it from going up, this is what I want you to write down in the piece of paper that you just prepared. When the barrier that prevents the market to go up is called a resistance. The name comes from the stock trading days because stock traders, they want the market to go up. A bullish market is the best market for them. So when this barrier is preventing the market to go higher up, they call it a resistance, which for us is not, for Forex traders, not much of a resistance because, I mean, we're gonna have fun on the way down as well. And therefore, the stock traders, they called the barrier that prevents the markets to go down, they called it support because it's supporting the prices to fall further down. Again, I don't think we should call this support and resistance in Forex trading, but it is a universal language, and we're gonna, we're gonna continue with that language here in our education series in the webinars as well. So the resistance level is an imaginary line that is based on a market psychology analysis that prevents the markets to go further higher up. And support is an imaginary line that is also based on market psychology that prevents the market price to fall further down. So I've been talking about technical analysis throughout this word over and over again. What is technical analysis? We covered this in our previous webinar. Let's see how. Okay, so we did cover technical analysis in the previous webinar, and just to give you a summary of what it is the study of the markets. It's the study of the history of the markets. And even though what happened in the past is not going to happen exactly the same way in the future, but I suppose a lot of you have heard this saying that history repeats itself. Type in a yes if you've heard of this, history repeats itself, right? So that happens in the Forex market or in any other charted market as well. And the best way to see the history of the markets is to have the prices printed out in a chart. So this is a chart. It's nothing scary, and it's one of the best ways to use for analysis. I'm sure on your Orbex platform you can see just a screen with the prices, the current prices at the moment. But the best way to trade is to actually trade on the chart to see what happened in the past and to set up your analysis for the future and the present. Here I have this question: why use candlestick charts? Type in yes if you've heard of candlestick charts. Right, Mohammed says yes. So candlestick charts were okay. Here it says that I'm experiencing network connection. I want to quickly check in to see if you can still hear me. Type in yes if you can still hear me. Okay, it seems that we're doing okay. So candlestick charts were actually invented by the Japanese, and it is an evolution of the bar sticks and the bar stick charts, which doesn't show the direction of the market in a specific time period by colors. If you can see in this chart that I'm showing you right now, you can see a lot of green and purple candles on the chart. I have set it in this color because of my own preference. A lot of times you can see green and red, blue and red, and other colors for the candlesticks. But the good thing about using candlestick on your chart is that in a glance you can know what an overall movement of the market is at a specific time period. So these are the basics. The horizontal line shows the time, and the vertical line shows the price. And this is the euro versus dollar candlestick chart, where you can see the euro's price in terms of dollar. Basically, this means that for example, over here is very small. If the euro-dollar price is 131, that means that 1 euro is $131. That means that you have to pay $1.31 to buy 1 euro. So that is something. This is something that some people have trouble with about the price and the currency pair. So this is again what I want you to take in a note, and it's a very easy formula that I use. So when you see euro dollar, because the currency pairs always come in the same way, same direction. You have euro dollar, Aussie dollar, dollar yen. You don't see dollar euro. It always comes in the same pattern. And if you want to know what exactly it means, it's as if you say, if you see apple per dollar. What would that mean? That means 1 apple is 1 or whatever the price is dollars. So that is the exact thing that is happening in the currency pairs. 1 euro is whatever the price is dollars. So that is a quick trick that you can use to better understand the nature of the Forex market. Okay, so without further ado, now that we had a little bit of background about the Forex market for our beginner guests today, we are going to dive into Mr. Fibonacci. It is an actual person's name, but that is a nickname. Mr. Fibonacci's name was actually Leonardo Pisano Bigolo, and he was a very, very geeky mathematician since he was a kid. And he always used to play around with his numbers and come up with new patterns and new series that we're going to talk about later. But one thing that a lot of people don't know is that Leonardo, or Mr. Fibonacci, he is the one who introduced the decimal system to the West. Before that, the West used to still use the Greek, Latino, those weird-looking numbers for their system. So this made math a lot easier for the public. So Mr. Fibonacci's most famous series is what we're going to talk about today, and how we use that in technical analysis of Forex. So he came up with the growth of rapid population. You see, this series that goes 1, 1, 2, 3. Do you see the pattern over here? So 1 plus 1 is 2. 2 plus 1 is 3. 3 plus 2 is 5. So you're basically adding the two numbers to create the succeeding number. And there it goes until you can just do this for eternity. And this is basically the most famous Fibonacci series that is also used to explain the growth of rabbit population, because bunnies have a lot of bunny kids, and this chart shows how they grow, which is quite interesting. So his series are used in so many different levels and so many different industries. So the Fibonacci series that we use in Forex, though, is not these numbers. It's actually the retracement levels that are calculated by dividing these numbers and creating new numbers. So as you can see here, if you divide any number by a succeeding number, let's go back to the number over here. So if you divide 2 by 3, you will get approximately 0.618. So I want you right now, if you're having your calculator in front of you, or if you have a phone that has a calculator, divide 2 by 3. It's going to give you 0.6, right? Then you can divide 3 by 5. Just type in the chat box. What do you get? Okay. So we're dividing each of the numbers. I want you to do it so that you could get a better understanding yourself and tell me if I'm miscalculating myself. So dividing 3 by 5, you get 0.6 again. Dividing 0.8 by 13 this time. You get 0.615. You see, so it's not exactly 0.618, but it's approximately that. And so that's why we don't use the last decimal place for our retracement, and we just call it the 61% Fibonacci level. So basically, the level is 0.61, but later that I'm going to show you the levels on the chart, we call it the 61%. We multiply it by 1,000 to make it, by 10,000, to make it more easier to pronounce. So the next level in the Fibonacci retracement level is 0.382, or the 38% Fibonacci level. So this time you are taking the ratio between alternate numbers. So basically you're dividing 5 by 13. You're dividing 13 by 34, and so on. So you approximately get 0.382 for this level. And the next level, which is the 23% Fibonacci level, is the ratio between every third succeeding number. So we're not going to get into this more than this. There are other levels for Fibonacci retracement, 71%, 61%, which is also a very important level, especially in the Forex trading, but we're not going to get into that. But I just wanted to give you the introduction to the retracement. But if you're getting scared right now, don't be, because you don't have to do the calculations yourself for Fibonacci. This happens just by clicking on the Fibonacci retracement tool on your chart. You can, your Orbex platform will calculate the retracement levels for you, so you don't have to do that. But in order to remember the levels, I just thought that it would be good to have a little bit of a background about the retracements as well, so that you're not like, okay, who is this Fibonacci and why are we using it? So let's get to business and see how you can use the Fibonacci retracement levels on a chart. As you can see, I've drawn the Fibonacci levels over here on this chart. This arrow, the green arrow, shows an uptrend. So the way that we're going to use Fibonacci today is to calculate a market rebound. As we said, what goes up must come down, right? So what a lot analysts have come to realize is that what goes up very powerfully comes down to key levels in the Forex market. And these key levels that coincides a lot of times with key support and resistance levels that we talked about before, they also fall onto one of the Fibonacci retracement levels. And the most powerful Fibonacci retracement levels in terms of reversal signal are the 50% and the 61% levels. So the idea is that the market is going to go up to a high, to a resistance level that it cannot go further up, and then it shows a rebound, most of the times to 50% Fibonacci level, and then it shoots back up just to hit another barrier. And then this works also in the bearish market as well. So if you have a bearish market that we're going to talk about in a little bit as well, in the bearish market, the market is going down, it hits the 50% Fibonacci level, and then it shoots, it goes up a little bit and up to 50% Fibonacci level, and then it shoots back down. So this is the idea. You can either take a snapshot of this presentation on your computer so that you get the general idea, because this is the most simplified way to introduce Fibonacci. And once you're done, we're going to go to the next slide, which shows Fibonacci in action on a real chart. Okay, I want you to focus right now on this chart on the left-hand side. So it is August 10 in 2010, and you can see a powerful uptrend. in this chart, in this Forex chart, I believe that this must have been the euro dollar because of the numbers that you see, the 132. So this is the euro dollar chart, and the market is going up. This is the daily chart, and that is when I decided to use the Fibonacci retracement. So the way that you draw the Fibonacci retracement is to basically, you click on your platform's Fibonacci retracement tool, and you drag your arrow, your mouse arrow, you click and drag the arrow from the bottom of this uptrend to the top of the uptrend that you think it's not going to go anywhere further up. And the way you can identify the high of the trend is, again, to identify the resistance levels that we have talked about before. We are going to cover it later on as well, but right now we're going to focus on Fibonacci. So when you identified your trend and you created your Fibonacci retracements on the chart, you see the levels magically appear on your chart. So as you can see here, we have the 61% level, we have the 50% level, we have the 38%, 23%. Okay? So as we said before, the market usually retraces back to either 50% or the 61% level. So now what you can do, there are two ways of trading this market. You can either decide to trade the market on the way down to the 50%, or you can decide to trade this market on the way up after it hit the 50%, or you can do both, right? So look at this chart on the right side now. What happened? By September 1st in 2010, this market went all the way down to the 50% Fibonacci level. Now look at the candlesticks over here. I'm going to introduce you to the candlesticks that are going to help you identify and realize if this 50% is powerful enough to hold the market or not. And the reason why it is important to use the Fibonacci retracement levels on the candlestick chart is because the candlestick charts can give you further identifications. So here you see two spinning tops. We're going to get into that later, but a spinning top candlestick pattern is the one that you can barely see the body of the candlestick. It's a very short body, but it has very long legs. So this shows market indecisiveness, as opposed to this very long candlestick, bearish candlestick, that shows that investors are so bearish the market that nothing can stop them and they're not even testing the market. These candlesticks are very short, and the traders and the investors are mostly testing the market during this time frame that the candles will build. So this is the daily chart. So in this day, on September 2nd, the market opened here and it closed here, but it tested different numbers. So that shows the indecisiveness and further indication that the market might reverse. So over here, not only we have the 50% Fibonacci level as the first indication of reversal, we also have the candlestick patterns that is showing, that is also backing up our Fibonacci analysis. And of course, we're using only two analysis systems here just to simplify it, but at that time, if I wanted to trade, or I think I did trade this market myself, I obviously kept up with the market events, what is going on, if anything, what is the outlook for the euro and what is the longer term outlook for the dollar, and if everything added up, I would place a buy order over here at the 50% and wait for the market to go back up. Or, as I said before, you could have placed a sell order over here at the 0% or the high of the high trend and made some pips, made money, while the market was going down to the 50%. So there are two ways of trading the markets based on Fibonacci in an uptrending market. Next, we're going to look at the Fibonacci retracement levels on a downtrend. Okay, so this is the pound-dollar 4-hour chart. And we noticed that in November, I assume this must be somewhere in 2010 as well, because that is when I wrote the book that I actually copied the book's pictures for this slide. In 2010, the market hit a high over here, a swing high or a high, however you want to label it, and the market started to go down, very bullish, up to 1.56620, which is a swing low. How do we know a swing low? First of all, because it must have coincides with another resistance level at this level as well, and also because we see this yellow, very bullish candlestick right after it hits this level. So we can see almost that the market is trying to rebound, right? So here how I traded was I actually waited for the market to move back in this chart on the right side to the 50%. I'm sorry, no, we actually, so this is where we sold. So we placed a buy order around here once we confirmed the market rebound, and we set our stop limit at the 50%, and that is how we made pips. So as you can see, this is exactly what happened. The market was going down, then it went back up to the 50% level just for a rebound, just for a temporary rest, if you want to call it that way, and then it shoot back down again. So you could have made money on the way up, or you could have made money on the way down. Both ways are again possible, just like a Fibonacci on an uptrend. Yeah, so actually I didn't know we have this one slide. So this is the completed chart after it was all done. So we had the market hit this level, it went up, we sold here and waited for the market to go down, and we took profit and exited. But you can notice that the market even went even further down than what we had anticipated, right? So that is the tricky part, because yes, obviously you could have made more money if you had not set a stop limit right at this level, but you know, the markets are not that predictable. Sometimes if you can afford to take that much risk, to just wait and see if the market is going to go further down, you can do it by calculating your own risk appetite and your own capital. But what I recommend normally is to set your stop limit based on the Fibonacci levels and not more. And if you see further indications, you can always get back to the market. So over here, you took your profit at 1.56620 and you went out. But then you saw this break from this key support level. So that could have been an indication, and then you had it, which was followed by a period of consolidation, right? So here, you couldn't have been that sure the market is going to shoot back down until another break was confirmed. So you can get back to the market again anytime, but it's better to be safe than sorry, because what would have happened if you didn't set your stop limit at here and the market did go down up to here, and after here it suddenly started to go back up and you hadn't taken your profit yet, so you wouldn't have made any profit, right? So it's best to set your stop and limit, and the Fibonacci retracement levels can help you with it. So the levels are used so you can use the levels based on your own risk appetite, right? So a more risk-averse trader could set the limit or the stop over here in a bearish position on even 23% Fibonacci level. That is a way more risk-averse stop order or take profit order comparing to this one. But another trader with a larger risk appetite would set this level, or even they would find a different level that they want to take profit and get out. So these levels, the Fibonacci retracement levels, can give you the exact numbers of where to set your stop loss and take order. And the stop loss, I think I missed out on explaining to you. The stop loss is if the market goes against you. So in this case, if you entered a bearish position and you sold the market at 50% Fibonacci level, you would set, and I definitely highly recommend that you set your limit order, your stop loss order at one of the other Fibonacci retracement levels. Like you can choose one level up. There is another level of Fibonacci that you can have appear in your platform as well, which is a 76%. We don't have it in this picture. I'm going to show you on the live market later on. So you can use the levels to set your stop loss and the take profit order. We are going to another live chart just to back up the support and resistance levels that we talked about at the beginning of our webinar. So as you can see here again, this is the dollar-yen daily chart. This is relatively new. This is from last week, actually, this chart, that the market, as you might have remembered, the active traders who are in our guests today might remember that the market was going up rapidly from end of July up until beginning of September, and then we saw a rebound, which was actually very overdue because nobody was anticipating the dollar to go up this rapidly. And once we saw the bearish movements coming in, that is when we knew that the market is exhausted and it needs a reset. And that is when we decided to use the Fibonacci retracement levels to see how much this market is going to go down. And after choosing the levels, you can see that the 23% Fibonacci level, 38% Fibonacci level, after the market broke below the 20% level at 107.85, we were damn sure that the market is going to go down at least to the 50% Fibonacci level, and that did come true later on. I'm going to go back to the live market later. So using the Fibonacci level for support, these are the support levels, basically. Just simply put, the 38%, the 50%, and the 61%. So if you have entered a bearish trade around 107.85, which is your pivot point, which is an indication that the market is definitely going to go down, you can set your support levels at any of these three levels. If you have a higher risk appetite, you set it at 104.32. If you have a lower risk appetite, you'll set it at 106.50. Okay? And this is going to show you how to use the Fibonacci retracement levels for resistance levels that we again talked about at the beginning of this webinar after the market hit the low. So this is again very interesting. How we know that this is a low is because we had a very powerful bearish candlestick over here, followed by immediately by a very powerful bullish candlestick over here. So that again means that the investors and the bears and the bulls in the market are not in good terms, and they're fighting and they're challenging each other head to head. So this could very well be a beginning of a rebound from a bottom. That is why you create your retracement levels on the downtrend. And after, so the first level is always your pivot point to confirm that the market is going to rebound at least to the 50% level. So you can make money either on the way up to the 50% or wait for the market to hit the 50% and make money on the way down, or both at the same time. And the support levels can be used, it can be selected by the Fibonacci levels over here at 1.3100 or 1.3270. So we talked about the candlesticks that are going to additionally help you with the reversal indication. And we already I already showed you the markets in an uptrend and a downtrend. And the reversal patterns, this is just a simplified version of a downtrend, and this is a simplified market reversal pattern in an uptrend. So let's say the market was going down over here. This is a bearish candlestick, right? And then you see this candle. Or a little bit further, you remember that I showed you the spinning top candlestick, right? When the investors are very indecisive as where the market is going to go. And that is followed by a very strong bullish candle. This indication, if this indication happens during a 50% Fibonacci level, you'll know that the market is going to go back to that trend, right? This is called the morning star. The reason why is that a darker candle is followed by something like this that looks like a star, and then it's followed by a lighter candle. So it kind of shows, it's probably a metaphor of the night going back to day. The dark is going back to light, and the market is going to go up. So that is why it is nicknamed as morning star candlestick pattern among traders. And then, exactly the same way, we have the evening star for an uptrending market reversal pattern. So if the market is going up and is going up very powerfully, it's followed by an indecisive candlestick where the market is either going up or down, and then it's followed by a strong bearish candle and if that can signal a rebound, especially if it coincides with a 50% Fibonacci level. So you can use that and mix and match the two indications to make sure that your analysis has a higher possibility of and a higher accuracy. One of the other trend-changing candlestick patterns is a bearish engulfing and the bullish engulfing patterns. The bearish engulfing is a reversal pattern for during an uptrend. What happens is that you have a number of bullish candles over here, and then you have a very strong bearish candle that basically can eat up or engulf the previous bullish candle, and that can be an indication of a trend change, especially if this happens at the 50% or 61% Fibonacci level and can back up your retracement analysis. Likewise, in the bearish market, as you can see here, if a smaller bearish candlestick during a downtrend is followed by a very large bullish candle, that can indicate that the market is done going down, and now we can expect the market to go up, right? So the candlestick patterns by themselves, I want you to take a note on that. The candlestick patterns by themselves are not that strong of a technical analysis, and you should always try to use them with other technical tools, especially they are very powerful when you use them with the Fibonacci retracement levels, because they happen a lot. Like you can see on a chart, you can probably identify so many of these bullish engulfings or bearish engulfings, but unless they coincide with a key resistance or support level or a Fibonacci level, they are not that powerful. So keep in mind that and avoid analyzing your trades only based on the candlesticks, and always back it up with key support and resistance levels. So this was it for today and the presentation. I did promise that we're going to go to the live market, so I am going to show my live market to you and see what happened to the dollar-yen pair that I showed you before. You remember the market was going up, and we anticipated that the market suddenly started to go down around here. Even though we have this bullish candlestick over here, the market indicated this indecisiveness. Do you see this bullish engulfing, a bearish engulfing over here? So the market was going up strongly. Then we had this small little bullish candlestick, which is followed by this very large bearish candle. This is exactly a bearish engulfing. That was an indication of a trend change. So around here, we already knew that the market is going to have a rebound. So what I did was actually I placed an order around here. I got a little bit nervous around here because the market went back up, but it did again come back down exactly at the 50% Fibonacci level at 105. And then we had another indecisiveness, and you can see from this arrow that I did make money over here, right? So I did make money on the way down, and now when the market hit the 50% Fibonacci level and broke above the 38%, I was sure that the market is going to shoot back up. So I didn't place my second bullish trade right at 50% because I wasn't sure. And obviously, I did back up my analysis at the time with other indicators that I'm not showing. I'm only showing the Ichimoku cloud over here that we covered in detail in our previous webinar. But as you can see, the market is above the Ichimoku cloud, which indicates that this is going to continue on its uptrend eventually, and this was a minor temporary rebound. So for that reason, and after this rebound was confirmed when the pair broke above the 38% level, you see, so it went up, it broke above this level, and it confirmed the break by opening higher. You can see this gap over here opening higher the next day. This was last Monday. So that confirmed that the bullish trend is going to come back in, and that is why yesterday I put in my bullish trade, and I'm waiting for the market to go back up to 110. Okay, so we'll see how that happens. I was very excited today to wake up and see that the market is going all the way up. So we should expect the market to go even further up. But as always, please stay tuned with Orbex updates. We have the videos. They have written articles and updates every single day posted to your email. If you haven't subscribed for Orbex trading analysis, you can do it right now. If you have any questions that you forgot to ask today, and if you go back to the to your notes and you have any questions, you can just send an email to info@orbex.com, and they will transfer it to me, and I will personally respond to your questions. We are running out of time, so unfortunately we don't have time for Q&A today. I am looking forward to seeing you tomorrow in our next webinar that is scheduled for next week, I believe. So have a great day and trade responsibly with Orbex.